crash everyone's talking about for 2026 might actually be worse than 2008, but not in the way most people expect. Back in 2008, the assets crashed. Stocks dropped more than 50%. House prices in many places fell 30 to 40%. Banks were failing. It was brutal. But if you had cash and patience, you got a second chance. You could buy good houses and good companies at huge discounts and ride the recovery. A lot of people today are waiting for that same movie. They think, I'll sit in cash, and when the big crash comes, I'll finally buy the dip. The problem is, the numbers we're seeing now suggest a different kind of risk. If I'm wrong, you just end up with a solid, boring portfolio. If I'm right, you avoid being the person whose safe cash crashes quietly while the index is still at all-time highs. So let's slow down and walk through what might really happen around 2026. First, the old crash that lives in everyone's head. In a classic 2000 or 2008 style crash, you get a deflationary shock. Asset prices get smashed, your stocks go down, your house goes down. The news is pure red. It feels terrible. But there's one hidden comfort. The money itself still works. Your dollars or euros might actually buy more after the crash. If you kept your job and kept some cash, you could buy the same assets at half price. That's why older investors keep saying, just wait, the big sale is coming. The problem is, the world we're standing in going into 2026 doesn't look like pre-2008. It looks like something we haven't seen in our lifetimes. A system where the foundation is creaking. Take one simple data point. In the United States, the government recently ran a deficit of about $1.8 trillion in a single year. That's the gap between taxes coming in and money going out. On top of that, the interest bill on the existing debt is now close to $1 trillion a year. That's just interest. No debt reduction. Interest costs have roughly tripled since 2020 and are now a big slice of the budget. Imagine a family that makes money every month, but almost every fourth or fifth dollar doesn't go to food, rent, or savings. It goes straight to interest on old debt. They're not paying the debt down. They're not getting ahead. They're just paying enough to keep the bank from calling. That's what many developed governments are starting to look like today, spending more and more just to cover the interest on past borrowing. To keep that game going, they have two main tools. They can keep borrowing, or they can let inflation slowly eat away the value of the money. This is where the idea of a different crash comes in. In 2008, the main bubble was in housing and credit. Today, a lot of the risk sits in the things everyone calls safe, government bonds and the currency itself. If the whole financial system assumes government debt is risk-free, but the math only works if inflation stays higher and the debt never really shrinks, then what's actually at risk is your purchasing power, not just the stock index on your screen. Now let's look at stocks. On paper, 2025 looks like a nice normal bull market year. The S&P 500 is up, new all-time highs, everyone happy. But look under the hood, just 7 big tech names, the so-called Magnificent Seven, now make up around 35 to 37% of the entire S&P 500. That means more than a third of the US stock market index is basically Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Tesla. When those guys move, the whole index moves, even if the other 493 companies are barely crawling. Analysts have spent this year talking about the S&P 493 separately, because without those 7 giants, the rest of the market looks much weaker. And what's driving those giants? A huge part of it is AI spending. Global AI-related investment is set to explode over the next few years. Companies are pouring hundreds of billions into chips, data centers, and infrastructure. At the same time, the IMF estimates that around 60% of jobs in advanced economies are exposed to AI, meaning the way people work can be heavily changed or partly automated. So here's the picture. Governments are running large deficits and paying high interest. Investors are crowding into a small group of tech giants that are spending massive amounts on AI. And many people don't trust cash because savings accounts often pay less than real inflation. If that sounds a little familiar, it should. Back then, everyone was right about the internet being the future, but many still lost everything by paying any price for any .com stock. Now we have the AI version of that story, but layered on top of record government debt and more fragile, safe assets. This is where the idea of a reverse crash comes in. In a normal crash, asset prices fall and cash is king. In a reverse crash, your charts might look okay or even go up, but your money quietly dies in the background. You feel it in rent going up, groceries that are 30 to 50% more expensive than a few years ago, insurance, energy, and education taking more of your paycheck. You're working the same or harder, the index is at record highs, but life feels tighter. That's already reality for many people. If something breaks in 2026, it might show up more in bonds and currencies than in a dramatic 50% stock crash. So what could that look like? You might see a sharp move in government bond yields if investors decide they're not being paid enough to hold long-term debt. When yields jump, bond prices fall. Pension funds, insurers, and conservative portfolios take hits. Governments face even higher interest bills and are forced to choose more inflation, higher taxes, or spending cuts that voters hate. At the same time, if AI spending doesn't quickly turn into real profits, some of today's valuations could deflate. Not necessarily a dot-com-style wipeout, but enough to drag markets sideways or down while living costs stay high. So instead of one big crash day, 2026 could bring a series of smaller shocks. Bond scares, corrections in AI names, currencies wobbling, and another year where your salary lags behind your real expenses. In simple terms, instead of assets falling to match your cash slides down to chase the assets. That sounds dark, but let's bring this back to you and your decisions. First, stop waiting for 2008 to replay exactly. Yes, there can always be a sharp sell-off. A 20 to 30% drop can happen faster than you think. But building your whole plan on "I'll buy when everything is 50% off" is dangerous in a world where policymakers are openly using inflation as a tool. Second, don't use leverage as a shortcut. In an environment with higher inflation and unstable rates, margin can wipe you out quickly. You don't need leverage to build wealth over 20 or 30 years. You need time, regular contributions, and assets that actually produce something: profits, rent, dividends, cash flow. Third, be honest about your mix of cash, bonds, and productive assets. Cash is important. You need it for emergencies and short-term needs. But cash is not where I'd park my entire future if governments are slowly eroding its value. For long horizons, I'd rather own pieces of real businesses through broad low-cost index funds, and maybe some real assets like quality real estate or infrastructure, depending on your situation. Fourth, remember how concentrated modern indices are. If roughly a third of your index is tied to one theme and a few companies, you're not as diversified as you think. That doesn't mean you should dump tech or AI. It just means you should understand how much of your future is riding on one story. Fifth, invest as if the system will stumble forward, not vanish overnight. Most of the time, even with scary headlines, the world does not end. Debt gets inflated away slowly. Governments adjust. New industries appear. That's why I keep coming back to the same boring core. Steady investing, broad diversification, and a time horizon measured in decades, not in election cycles or news cycles. And here's the key point. The real crash to worry about isn't just a red candle on a chart. It's waking up 15 years from now with no assets, no skills, and a currency that buys half of what it used to. If you keep improving your skills, avoid dumb debt, and regularly buy productive assets with money you don't need tomorrow, you give yourself a real chance, no matter what version of the 2026 crash we get. Whatever happens in 2026, I want you in the group that understands the game and is quietly prepared, not the group that's shocked when the old playbook stops working. If you found this useful, give the video a like, and if you want more simple, steady explanations like this, hit subscribe. Thanks for watching.